Hello, everyone. Today on the final bar, my guest is Peter Brandt, a prolific social media writer and author of the Factor Report, to share some big picture observations about the market environment. Today, we have the S&P holding up pretty well and breadth characteristics that seem to improve. We talked a little bit about dollar weakness yesterday, and I think we're going to continue along that path, understanding how that relates to all the other asset classes we're looking at. Also answering some of your questions from the final bar mailbag. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the charts together, understand the short-term ramifications of what's happened today, but most importantly, connect the short-term with the long-term and think about the trajectory of the market, the long-term momentum shifts, the inflection points, trying to be on the right side of the trends and understanding how those trends are evolving. You know, we had an interesting rally into the close today, and so again, earlier in the day, if you look around 10, 11 a.m. Eastern time, market kind of pulls back, goes in the negative for the day, and it felt like maybe this was a continuation of yesterday afternoon sort of digestion phase of processing the recent gains. But then we again, in the last 30 minutes, when it tends to be institutions, ETF, purchasing, things like that, market rallies pretty good, pushing the S&P up a little bit higher. So we're going to talk about some of those themes and where we're at with the long-term trends in an environment where the equity market just seems to continue to want to go to the upside. It's a path of least resistance, I would say. We have a great guest today, Peter Brandt, whose work I followed and very much appreciated for a number of years now. We have some fantastic other guests joining us later this week and next as well. So tomorrow we have Frank Capillari from Instinet joining us on the 4th. On Thursday, we have Greg Harmon, who's a fellow Clevelander. And then next week, we have Dana Lyons from Lyons Capital Management on the 9th. On the 10th, we have Mark Ungewitter. Also, our next episode of Behind the Charts coming up this Monday is an interview with Price Headley. Price is an options expert. I've known him for a number of years through the Market Technicians Association. Enjoyed reconnecting with him, talking about one of my favorite comments of his was how he dealt with the stress or the anxiety of investing. And he made a great comment, which is, if you find yourself not being able to sleep at night, your position sizes are too big. And he had little moments like that along the interview where I remember just kind of mentally noting, well, I thought that's a really good point there. So I hope you can join us for that one, Behind the Charts, coming up this Monday, the 8th, with Price Headley. So for a market recap, as I mentioned in the introduction, right, equities just continue to go higher. When I've had a lot of discussions, I've called this a bear market rally for a while, and over the last month, I feel like that picture has evolved, for me at least, transitioning from thinking of it as a bear market rally to just recognizing that the trend is positive. And as we continue to make higher closes, as we continue to make higher highs, as we continue to pull back and have the lows become a higher low from the previous price swing, the previous pullback, the market is in an uptrend. And that's not a judgment call. That's not an opinion. That's just by fact. And that's what Charles Dow contributed to technical analysis, 100 odd years ago, was, pointing out that markets move in trends and coming up with a simple way of defining those. So I think you have to note with days like today that keep going, as much as we keep thinking, is that a blow off top, is at the end, there are plenty of indications that suggest in some ways that, the market becomes overextended. I think a lot of things are nearing resistance, especially in tech and healthcare, as we've talked about over the last week, I think in great detail. But again, until the market stops going up, the market's in an uptrend. And again, if you're not there yet, I think mentally starting to embrace that can be really helpful. This up move and really the rally into the close pushed the S&P up to 3080. That's up 0.8% from yesterday. The NASDAQ 100 up a little less, but still up 0.6%. From Monday's close. Mid caps, small caps up a little more, but they were all pretty similar in the 0.8 to 1.1% range. So sort of a fairly widespread uptrend across the equity markets. Let's look at a chart of the S&P 500. We'll come and dig a little deeper with it. So as I was mentioning, right, I think We talked about this resistance area, talked about S&P 3000 needing to see the market break through and follow through. And again, I think we've seen that. The trend remains positive. Seems to me the path of least resistance is higher. And again, why the patterns emerge as they do, I think is something for a well-rounded investor to debate, to speculate, to think through, to challenge the thesis. But at the end of the day, for me as a technical analyst, if the market's going higher, I want to be owning that market. I want to assume that that trend's going to continue. And I think that's what we're seeing with the S&P. I think at this point, we've broken above it. I think, the trend remains positive on any pullback. I think that 3,000 level, the 200-day is super, would be a super key level to pay attention to. But I see the market going higher. I see the RSI continuing to go higher than 60, which puts it more in the bullish range. It's more of the range that goes with bull cycles. Patterns going higher. Let's look at some of the other asset classes. Then we'll look sort of the next level down and see what sort of potentially drove that movement in stocks today. Bonds off a little bit today, down 1/3%. The TLT going down just below 162. 10-year yields going up to around 68 basis points. On the commodity side, you had oil going up pretty consistently through the day. This is the USO that we're looking at that finished up 3 1/3% higher. Gold was actually down a little bit. Silver is a market we've talked about in our Q&A section. In the mailbag segment, I'll answer a question on gold and silver. But silver was actually one of the worst parts of the commodity complex, down 1.5%. Although, again, the overall trend still appears to be fairly positive. Same with gold. A lot of that sell-off came in the morning session for sure. Looking at sector rotation, energy, materials, industrials, I call the MEI, sort of that late cyclical trade, all at the top of the list today, with energy up 2.7%, materials 1.8%. On the bottom, you have consumer staples gaining the least, followed by communication services, followed by healthcare. Healthcare is an interesting one, continues to underperform. This is a sector with biotechs, with pharma, with medical supplies, all had done very well, especially on a relative basis, but continue to sort of be at the lower end of the return list every day and underperforming the market, even though they were positive, not as much as the overall market environment. Technology sort of flat for the day relative to the market, didn't really gain, relatively speaking, sort of flat with the market, a market performer along with consumer discretionary. So two of those, sort of leadership sectors, I'd be looking to see if they can continue higher, both finishing a little bit higher, but not really driving much further than the market. In terms of global ETFs, this is a global ETF universe that I usually pay attention to. Brazil up the most, the EWZ almost 6% today, followed by Hong Kong EWH up 3%. So obviously a lot of news flow around the Chinese market around Hong Kong today, for what it's worth, up pretty good. At the bottom, you had more developed markets at the lower end of the range with Switzerland and Japan, the two least gaining, but all of the global ETF universe we follow finished in the positive today. In terms of industry groups, sort of a mix, but it's all sort of the MEI groups up here. So you see things like aluminum stocks, a lot of energy groups up at the top in the top 10, a couple random industrials groups up here like heavy construction, and only one consumer group out of, two. The tires group is a pretty small group here within consumer staples, and then durable household products within consumer discretionary up pretty well. In terms of groups that were down, gold miners and mining stocks at the bottom of the list. We talked about Newmont Mining being an interesting participant in the top of the Scooter rankings, being a consistent top ranked stock according to our trend or rating system. That's sort of come off. Newmont Mining's fallen off the top 10 for the large cap stocks, and the gold mining group has certainly pulled back, along with gold sort of pulling back from all-time highs recently. You also have automobiles losing a bit. This was one of the top groups yesterday with Tesla. Overall, we looked at in our consumer discretionary focus yesterday in part of our shifting stocks segment. But the automobiles group down, along with some other groups like travel and tourism, some REIT groups, toys, and different mixes of things. So, sort of an interesting relative movement. Some groups higher, some groups lower. Plenty of groups actually down on the day. So maybe worth paying attention to. On an up day, it's always interesting to see what groups did not participate in that. Same thing on a big down day, what groups are able to hold up okay. In terms of individual stocks, just to wrap up this market recap before we bring on our guest, Peter Brandt, I did want to point out, we've talked about these exchanges in this exchange group within the financial sector, and it's things like CBOE. What else is in here? S&P Global, Market Access are sort of all in this sort of similar theme of stocks that I would sort of look at. The stocks have rallied, and CBOE has done okay, pulling back a little bit, so down 2% today, which again is not, but does not concern me a ton. The relative strength picture is what's questionable. So if you compare this to some of the other names in the group, stocks like Market Access look a little better because they're coming off of previous highs, new 52-week high this week. Something like CBOE, not nearly recovering that. It's sort of in the lower end and still below a downward sloping 200-day moving average. So it's interesting to think about just within some of those groups. Remember, there's actually plenty of differentiation in there. Also, Gilead. So within the biotech space, healthcare as a sector struggling on a relative basis, and it's amazing to see the underperformance of Gilead from the market low. Right, so the market lows here. March 23rd, this bottomed out a little earlier, but since then, you can see how the relative performance has just been consistently negative for the most part. So while a lot of stocks are sort of, the S&P breaking above the 200-day, aiming, above 3,000, continuing higher, you have something like Gilead, which is establishing consistent lower highs. So if you're in names like this and you're wondering about them, again, I would in general much rather own names that are outperforming, whether, versus underperforming. And the weakness in the relative, the downtrend of lower highs and lower lows is what continues to concern me with something like Gilead. And I think looking at the swing low here, so a break below 72 would put it below that swing low from mid-May, and I think could give you a potential indication for the next leg lower on a stock like that. So biotech had been a fantastic group, some questionable charts now building within that group. We're going to take a quick commercial break. Back with my guest, Peter Brandt. We'll see you back in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you for joining us on our show every weekday after the close. As a reminder, we're going to do a mailbag segment a little later in this show. You can get questions to us anytime. The Final Bar at StockCharts.com. As you'll see with our Q&A segment today, questions can be anything about a particular technical indicator, chart style. It could be a particular chart that you're just trying to check your analysis. And again, happy to look at what you're looking at and give you some pointers based on my experience and the experience of many of our fantastic guests coming on the show. So just shoot us an email, thefinalbar@stockcharts.com. We'd love to answer your question in our next mailbag segment later this week. I want to welcome on my guest, Peter Brandt. Peter, I've followed your work for a number of years, and it's such a pleasure to have you on the show today. Thanks for joining me.
Oh, great! It's great to be on. Great to be talking about markets today. Thanks for your analysis the first 5 or 10 minutes. That was great.
I appreciate it. And we were talking before we started the show just about the dollar. I've been talking about potential dollar weakness in a shorter term basis, and it's great that one of the charts you sent was really a long term look at the euro. So in a way, looking at the dollar, what is this telling you about prospects for the euro and in exchange the dollar?
Well, of course, the euro doesn't go back as far as this chart goes, and so while it's labeled European currency unit against the dollar, once we roll back prior to 2000, actually, what it picks up is a trade-weighted basket of European currencies that really approximate what the euro would have been back then. But the euro's gained on the U.S. dollar at about 2% a year over time, and we're right down into that trend right now. We've gone into that trend before. We seem to go back into that trend every 15 years or so, and that's a half-century trend. That's a pretty strong trend, and we're scraping the bottom of that big trend line that we see right there. And there's some signs. I didn't send you the daily charts or some of the other charts, but there's some signs that we are bottoming the euro down in this area. And if we are bottoming the euro down in this area, that would indicate that we're going to see weakness in the period ahead in the U.S. dollar. We've already seen that, of course. We've seen, my goodness, we've seen the Russian ruble gain on the U.S. dollar substantially. We've seen the Mexican peso gain on the U.S. dollar. Dollar is getting beat up by a variety of currencies, and I think that we're going to enter a period where the euro currency unit could substantially advance against the U.S. dollar. I mean, we could see 10 to 20% advance by the European currency unit, and that would be a pretty substantial move.
Very good. And so for those that aren't super familiar with currencies, just to be clear, right? So you're expecting sort of a rally in the euro here, sort of strength in the euro. That would line up with weakness in the US dollar, $ USD on StockCharts.com. Now, when we're talking about the dollar, I'm immediately thinking of interest rates and how they relate. So you sent a chart of the 10-year future. How does that relate to your big picture view here?
Well, we're seeing a lot of liquidity come in from the Fed, of course, and the obvious conclusion is as the Fed is funding the financial system with U.S. dollars, it's causing some dollar weakness. I mean, that's the first conclusion I guess one would come to, and for the time being, I guess I'm going to accept that as a narrative, although I care more about my charts than I might about some global macro narrative. But
Sure.
yeah, I mean, we have a wonderful chart pattern developing, and I'm a chart pattern guy, and that's a huge ascending triangle. Mm-hmm. This is the 10-year note that we're looking at right now. But should we break through this 139.22 level as marked on that chart and do so on a closing basis, I think we basically go to zero interest rates. The target up there is just about a 0.11, 11 basis point yield really is where the target is up there. And that's a pretty substantial move. And that probably will be the U.S. joining the rest of the world, of course, with negative interest rates. We've seen Great Britain finally go there. The rest of Europe is there, if not more. Switzerland's at a minus 70 basis point yield and has been for several years. So it looks to me as if the U.S. dollar is going to join the negative interest rate crowd, and we could see a substantial move up in the 10-year, but also in the 5-year, across the entire yield curve. I think we'll see lower yields here in the weeks and months ahead.
And I think with your target, Peter, you're using the height of the pattern here and then projecting that from a breakout, and that's how you're getting to
yeah, exactly. I have two targets that you see. I have kind of one midway, which really takes the width of the more clear ascending triangle, but then the higher target really goes back down into that and pulls that March low into play, and then we get a target. But yeah, I mean, it looks to me, especially if we can break out to the upside, that negative interest rates are definitely in the cards for the U.S.
We only have about 30 seconds left, Peter, but we wanted to talk Tesla. We, yesterday looked at the automobiles group in a little bit of detail and focus a bit on Tesla and the potential upside. What are you seeing on the chart here?
Yeah, I mean, there's a lot of Tesla bears out there, but I've labeled Tesla as really a continuation head and shoulders. People will say there isn't such a thing, and I would say read Schabacher, Edwards, and McGee, and you'll find out that they talked about it.
That's right.
And that's good enough for me, by the way. But yeah, so I think with all the bears and the shorts, I think we're going to run the shorts in on this stock. People talk about it's ridiculous for Tesla to have the market cap it has right now, but hey, charts don't care.
It's such a great take. And what I love, Peter, about the things that you showed here, again, I've often found that the reasoning, the justification becomes very clear in the rear view mirror. The charts are what tells you where things are headed, and you've hit on some key breakouts to pay attention to. Peter Brandt, it's such a pleasure to have you on the show. Again, thanks so much. You do so much on social media, sharing your perspectives with people, and thanks for what you're doing, and thanks again for coming on the show with us.
Oh, you bet. We'll talk to you, Dave.
That's Peter Brandt joining us. He writes the Factor Report, and such a great take. And again, I hope what you took away from that, which I certainly did, is two things. The beauty of looking at price, the simplicity of what Peter was showing you, but the power in that. The power is in the simplicity of looking at breakouts and identifying where things could be headed and positioning yourselves for the trends, but also the benefit of looking at some of those long-term charts. How many of my guests have come on and brought longer-term charts that really put all of the noise that we see day to day into proper perspective? So Really great take there from Peter Brandt. Really appreciate him coming on with us today. I want to move on to our next segment, which is the final bar mailbag. One of my favorite parts of this show is making it interactive, hearing from all of you, hearing what you're looking for, what you're looking at. And again, my goal and our goal at StockCharts is to help empower you to make better decisions. And one of the ways we can do that is having a dialogue about what you're seeing and what you're running into that we could help with. So I'll answer some of the questions that we've received just in the last day or two to the final bar mailbag. First off, what technical analysis skills should every trader fully master that will stand them in good stead? I love the simplicity of that question. And your title to your email was Teach a Man to Fish and You Feed Him for a Lifetime. So I love your question. I love the spirit of it. So I will answer that in two ways. Number one, if your goal is to fully master anything, I think you will leave your trading experience somewhat frustrated because I've been doing this for about 20 years now and hope to continue to do it for many years on. I'm still learning a ton, and it's talking to guys like Peter that you pick up on ideas, going to conferences. It's working with a lot of my peers over the years to get inside their head. So, and again, I don't think you ever get to that point. And I'll never forget the first MTA meeting I ever went to. This is in New York in the early 2000s. I was amazed at the elder gentleman in the crowd asking questions of these presenters. And I remember looking around thinking, if this is an industry where you're asking questions still at that stage in your career, I love it. I'm so excited about that learning opportunity. It is not disappointed. So my first one is I would tap the brakes on your goal of fully mastering it. I would strive to reach a certain level of mastery, but you're not going to figure it all out. My direct answer to your question, I would look at John Murphy's 10 Laws of Technical Trading. It's in our chart school, so just go up to the top where you see a little magnifying glass, look for John Murphy's 10 Laws, and you will see this article in our chart school. And again, John Murphy's a legendary analyst and technician for sure. He wrote the book that for me and many others introduced us to the practice of technical analysis. While I do not follow every single thing he says in his explanations, I would say if you look at these 10 things, and if you come up with your own ways to answer those, how are you mapping the trends? How do you spot the trend and go with it? What is your approach to follow the averages? What are your warning signs? How do you track them? How do you decide whether something's a trend or not? And if you look at his explanation, he gives you some ideas of how you could do that. But what I found is the goal or the adventure of being a trader, being an analyst over your career is developing and improving on your ways to answer those 10 questions. So that's where I would point you. I would encourage you to start with John's suggestions and again, develop your own over time. And if you can do that, if you can answer those 10 questions on a chart you're looking at, you're in really, really good shape. I think you're approaching a good level of mastery. Question number 2, I'm a faithful listener to your show, and thank you so much. Looking for your opinion on this chart. Do you see silver as mostly bullish or mostly bearish in the short term? And I included your chart. There's beautiful colors on your sharp chart here. So well done. So I'll use your chart to answer it. Gold and silver have been fantastic on a relative basis. Silver down a bit today, 1.5 or something, 1.5%, I think. Maybe a little bit more today, but I think you're hitting on the conflict or the challenge of something like silver. It has had a fantastic run, this continuation pattern in April to May, sort of this consolidation, this coil pattern, breaking to the upside, breaking above this is the 400 day moving average. It looks like the 200-day for me was up here, and I think that was pretty meaningful. But for me, it's now entering this resistance range, right? So this 19 level on the silver contract that you're looking at is pretty significant. And again, we've got above there sort of this long-term high in September. So, the trend is positive. If you look at the price movements, if you look at the MACD, I think overall that's fine. So in my opinion, I tend to think of it as the path of least resistance is higher until proven otherwise. The trend is positive. What puts silver on sort of my warning list are some of the divergences that you're pointing out here. So you have a potential bearish divergence with RSIs, not as clear cut depending on what you look at. If you look at the SLV, might not be as clear as this. I'm sort of thinking it in my head, but you're showing the bearish divergence with the MACD histogram, showing you some inherent weakness a bit potentially on that last move higher. So you have a trend that's positive, but it's approaching key resistance. So for me, I'm going to follow the trend primarily. So as long as that remains positive, I think the chart is good. This is what puts it on my reversal watch, and I'd be looking for signs that it starts to reverse. Today, one day isn't enough, but if one day becomes multiple days and you see the turn happen, you start to see a rotation lower in the trend. I think you want to be a little more cautious, but at this point, the trend has been positive on gold and silver. Last one, and I'll skip to the real question here. Would you mind showing how professional technical analysts use equivolume charts? It's a really good question. So equivolume, one of the things as a technical analyst, when I've talked with my peers over time, so much of what we do is based on price and time, and it's price over 1 day, 1 minute, 1 month, whatever the bars are, but it's looking at price bars, and it's time on the x-axis, it's price on the y-axis, and that's it. And that's why things like point and figure charts and other charts that break that, and instead an RRG, for example, it doesn't just look at price over time, it sort of changes that. So point and figure charts plotting trend instead of time, so the time is less of a factor. I always find that kind of interesting. What equivolume charts do, and we only have a minute to sort of give you the quick summary, is what they try to do is make volume a little more meaningful. And instead of showing volume as its own bars at the bottom, the problem with that is price has a consistent weighting visually. What this does, what equivolume does, is a stronger volume day has a wider candle or a wider body. So the heaviest volume days are wider, the lightest volume days are a little more narrow. So what it does is it visually shows you when the market's rallying on lighter volume here, like in the first half of February, you can sort of see how the volume is drying up as it takes, it's quicker and quicker on the chart, less and less time to go up. And then you can see the volume increase on the way down. So it is a great way to visualize the relationship between price and volume. For me, volume has become less and less of what I look at, to be totally honest with you. I do look at things like unbalanced volume. Equivolume has been on my list of things like Heikin-Ashi charts are similar to that. Anytime I see someone who really uses them, I jot down a note thinking, I want to spend more time with equivolume and really see what it's going to make a difference for me. So I think that's how I use it now. Is it's a really great way of visually seeing when a market turns and seeing the end of a move when the volume really dries up on it. I would caution you though, if you look at indicators, be careful what indicators use. Something like relative strength, the spacing is going to be weird because it's changing the x-axis, not on time anymore, and so it could give you some interesting readings there, for example. That is our final bar mailbag for today. I want to thank you guys for sending in some fantastic questions. Again, the final bar at StockCharts.com is the way to get a hold of us. We need to wrap the show, folks, and we're going to go right to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P looking at breadth. Didn't have time to dig into breadth too much in our market recap, but I did want to point out some interesting developments here. I've talked about how looking at the percent of stocks above their 200-day, getting above 50%, would be key. We're getting really close to that. We're almost to 45% now. And again, for me, if you're looking for some sort of indication, if you are not buying into the S&P 3400 trend is your friend sort of mentality, I think getting above there, if you're not there yet, that should convince you. I think it's worth noting that almost 100% of the S&P 500 above their 50-day moving average. 2 months ago, that was at 0. So it's been a dramatic shift, which tends to be long-term bearish if you look over the long-term trends. 2 other quick charts here. The next one is the Qs versus the diamonds. That's the ratio here at the top. At the bottom, I'm just showing the S&P 500 on a closing basis, just as a visual reference. You can see how the Qs have been outperforming the Dow. Think of that as the NASDAQ outperforming the Dow, similar to the relative performance of technology. What's interesting here is you had a lower peak, you had a divergence with the Qs versus diamonds rolling over while the S&P continues higher. At the very least, this speaks to sector rotation, people going away from the big cap tech trade and into other markets, things like consumer discretionary, even energy that have been outperforming recently, financials at times for sure. If that trend continues, I think the safety trade of a lot of people in those big cap tech names could be a little more questionable than it has been. So I would certainly focus on the sectors if you've not done so yet. And another way to tease out that theme is looking at this, the equal weighted S&P, the RSP, versus the spiders, the SPY. And if you look at that ratio, if this is going down, the mega cap trade is working. If this is going up, the smaller mid cap trade is working a little more because the equal weighted version is outperforming the regular cap weighted version. The trend is going up in the last month for sure, and it's close to breaking a new swing high from April. If that continues, again, it tells you that to get away from the mega cap trade, focus more on some of the short-term outperformance. That's our show. Special thanks to our guest, Peter Brandt, for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.